Hello and welcome everyone to the weekly Delphian meeting. Thank you for your continued participation. So what we're going to do today, I have some kind of strain of the flu, so mine will be fairly short. I'm not feeling well, but Shawn's going to go through some earnings stuff. Here's a new kind of trade idea that we've been researching, so we're gonna, I think he's going to go through that. So let's get into the end of the show. So let's get into the market overview. So obviously everything's still stay one. You know, we had a big move down for one day. It's kind of the norm, you know, where we're seeing, you know, kind of small, like big moves, like 1 or 2 days, and then, you know, it kind of goes back to the, I would just say like below market. Not really bullish, you know, kind of very slightly bullish type of market. So let's look at the market pulse. Current states. Now we got around 60. You know, we dropped down just a little bit. Not much movement here overall. So, you know, no difference, you know, between last week. Even, you know, we had that big move and and then, you know, I think that was just mostly Yellen, you know. Yeah, opened your mouth about inflation, and you know, I've been talking about that for a while. You know, that could definitely, you know, any kind of expectation of inflation, you know, raising rates, you know, that's going to be a big problem for the market. There's so much debt out there. You know, it's going to be bad for everyone. You know, consumers and you know, floating rate notes, corporations. So if they start messing with that, you know, interest rates and driving those up, it's gonna be bad. It'll get ugly. So, so I think they got the message. You know, one day, pretty big drop. People didn't like to hear that. So, you know, we didn't have much of a new low spike here. At just 97. Typically, we'd, you know, on those big days, we'd see them pop up, you know, near 200, but this was barely a blip, you know, and long term, it's nothing as far as any kind of new lows. So, you know, just saying, you know, same thing, not really making any kind of new highs, excuse me. You know, just kind of blah, you know, as far as the market. Overall, we're not getting, you know, the breadth. You know, I did want to pull up kind of one way to, we talked about kind of sector rotations. And I wanted, before I go into the individual indices, I wanted to pull up what we have here. So this is under stocks all the way down there, analysis tools. So I think this is a good way, you know, to kind of figure out, you know, which indices, which sectors, you know, have been leading the market. So if we look at this 1 year.
I signed up for a bunch of classes.
I hear Pushpa. I hear Pushpa. So you look at this 1 year, you know, this is the X, you know, IWM, you know, and you can see the losers, you know, over last year, XLP, so that's consumer staples, XLV, which is healthcare, which is, you know, they're not getting all their, you know, even though the focus is COVID and vaccines, but that's a small part of the market. You know, a lot of the procedures and things like that are not going through like normal because of COVID. So those two have been lagging. So you have kind of your, I would say like, you know, your kind of winners up here and then your losers down below here. So if we, you know, kind of scale it back, you know, the 6 month, you know, still we had IWM, you know, which was kind of, you know, we had talked about that for a long time, how IWM But when we kind of pulled back to 3-month, now IWM's in the bottom. So obviously that's kind of fallen out of favor, not drastically. You know, you have your two kind of winners recently, XLB, so that's materials, and XLI. And XLI is just, you know, kind of been crushing it. You know, leading the orange right there is XLI, XLB. So those two, XLB, you know, that's material. So that's, you know, when things are inflating, prices go up, the XLB will do well. You know, so that's basic materials, you know, on all the commodities type things, you know, needed for industry. And, you know, kind of surprising, XLI, which is industrials, has been leading. So you can go all the way down to the 1 month. I don't think that gives us a great picture, but you know, kind of the 3-month will tell you, okay, we have everything down here, and then you got two kind of winners, at least over the past few months here. It doesn't tell me much. I think what we'll do is expand this so we can do the slider on this one like we do the other one. So anyway, you know, you can do the same thing. You know, that's sectors. So if we want to do SHG, SHV. You know, a lot of people kind of say value. These are the Schwab ones. So value and growth. SHG obviously is the growth. So this is another way you can kind of compare those. You know, see if you know how those two are mapping up. So you can do it for anything. You know, we got anything that has an option in the US market will be available to screen in here. So I'm sure there's ones for like small cap growth and small cap value. I didn't do all that research, but you can see obviously growth has been leading over that 1 year period. And then, you know, we kind of flip in here and then it goes down to the value being over, you know, and then 1 month we had a growth, and that kind of makes sense with how things, you know, popped up after, you know, the NASDAQ, you know, kind of ran down and then it had a nice run up and then, you know, it just crossed over again. So now, you know, the value is looking better overall. So it's a good way to track them. I just want to, you know, go into, you know, the deep recesses of the Delphian platform to show you guys that. You guys have any questions on that?
Hey, Josh, this is Lee.
Hey, Lee. Welcome
Hey.
back.
Thank you. Talking about value and growth,
Mhm.
how would you just 2 sentences about how you would define value or how you would define growth?
Yeah, well, I mean, growth you would think of mostly as like you can kind of split them up between dividend payers. Like most of the growth are not going to be dividend payers. They're basically reinvesting all their money into the actual corporation to facilitate, you know, large growth within the system. Whereas the value, or I would think, you know, for the most part, more mature. You know, like Apple went to a dividend payer, you know, a while back. So, you know, their growth, you know, that now they're paying dividends. So they're not, that money is not being reinvested into the company to, you know, basically spur growth. So I think it's more of like a mature, you know, type where, you know, they run out of growth ideas, then they'll move to like value. And you kind of seen that with Apple where, you know, they're not, you know, you haven't seen a new real product much. You know, they bought like Beats or, you know, some of the credit card, you know, but you haven't seen like a new device or something that they created, you know.
Right.
Where it's like Google and Amazon, they're still, you know, basically putting everything back into the corporation to try and grow it bigger and bigger.
All right, thank you.
I guess that's more than 2 sentences.
It works. It's helpful. Thanks.
Yeah. Okay. Anyone else?
I think that's probably, this is Dave, and I agree with you. I think that if doesn't pay a dividend, it's kind of could be more growth than value. The other thing that I think you could look at is the relative implied volatility of that stock. The growth stocks will have higher implied volatility, and the value stocks will have significantly lower implied volatility. And you might go back and just check to see where, I was just going to see what Josh just said about when Apple added their dividend and how the implied volatility changed, or if it did change during that period, or after they made that decision or rolled out their dividend.
Mm-hmm. Yeah. Okay. Well, thank you. Anyone else on that? All right. We'll run through. So that's just under your analysis tools under stocks. You got some other stuff here. The correlation I like. You can find things that are what's correlated to what. And the door sets. Okay, so let's go into SPX. All right, someone's loud here. Yeah, someone was loud. Okay, so SPX still above target 3. This is our average days, so we're 2 days away. So the key level here, obviously, is at target 3. Now, if that's going to provide support, if it does get down there to test it, but that's pretty much all we have on SPX. And drawing. So that's not a near-term thing. That the 50-day obviously still well above it. Yeah, I mean, you see that big market move. We were down pretty good, but obviously clawed back there, so it doesn't look as bad. But obviously, fairly having kind of ranges right here. So we'll see what happens. Obviously, well below that 50-day. I mean, well above that 50-day SMA. So nothing to worry about there. People. Okay. NASDAQ. So we always talk about the average move. It's not perfect, because normally I'll go up here, kind of test, and then go down here, and then run back up. So this one, really tried to get over this level and failed. So now it's back down at, around the entry price. So that's your key level here. And then, as we're moving up, see if it can get above that level. Obviously, you can see that T2 area is strong resistance. So, if we can break out of that, that'll be a very bullish sign for the market. Russell, as we saw, it's kind of lagging. If you look at the actual prices down here, we'll just kind of go here to here. Not just kind of consolidation. It's not like it's dropped below here and really lagging anything. It made such a powerful run over that 1 year, 6 month. That right now I think it's just consolidation. So we'll have to kind of keep our eye on the Russell. Obviously dropped below. Didn't really make it up to the target 1. Went below that first support, which is the entry price. So now basically we're going to see if it'll cut back through on the upside through that entry price and try and make a run at T1. Otherwise, the stop losses are the near-term support for that. Okay, those are kind of the quick and I'll open up the questions overall, the market or, any of the sector analysis stuff. Yeah. Okay. Shawn?
I'm here.
All righty. We're ready for you.
Sorry, still feel bad.
Yeah, it's bad. Yeah, the whole family's got it. So, yeah, we're ready for you to astonish us, Shawn.
I'll astonish you, I will. Yes, we'll see about that. No doubt. All right, good. So, yeah, just the normal stuff. I want to just talk about our, earnings trades. I want to kind of get an idea. We know certain people that have spoke before have been talking about the trades they've been doing, but does anyone have any other information that they would like to provide, any experiences of what they've done recently, of the trades that they've done, whether it be bullish pre-runners, vol crush, bullish runners, anything like that? I'm kind of opening it up at the start. Nobody? Okay. What I want to make sure and to bring to the attention what we've talked about before, within the earnings trades, and that doesn't, I don't want that to take away from the other studies and the back test trades that we should be doing as well within the platform. Those are all still really valid and really important to get in there and, back test some ideas in the platform, find new trades or new ideas that you could test and possibly implement if they perform well. But we always know, to come into the pre-alerts. We can come into the pre-alerts every day. They come out at 10 a.m. Eastern time, and then also at 3 p.m. Eastern time for the afternoon alerts. So, check these on a daily basis if you're coming in here looking for trades. You can track them. If you go back a day, you can actually track them in your virtual portfolios. So if I go EOD, which will be yesterday, end of day for yesterday, I can actually put these in my virtual portfolio by just clicking on this virtual portfolio plus tab here and add them to my virtual portfolio and then track them. So we can do it that way. I also want to make sure we're looking at the plan. Within the plan is going to give us kind of a heads up of what's coming up over the next couple of days or the next couple of weeks if we want to look at it that way. Currently, we're in the works of getting an email together. So the thoughts are we're going to have an email come out possibly, Sunday, Monday, to essentially give you a heads up of the trades that are coming out for that week, and not necessarily the trades, the specific trades with the specific strikes, because that could obviously change based on the days, and the movement of the stock until the earnings or until the bullish pre-runner time frame has come about. But at least if we were to say, on 4/20, let's just look back at a couple days, like on 4/20, let's say 4/18, we would come out on that day, or 4/19, and say, hey, AYX is coming out this week with earnings on 4/23. So you would know a handful of the stocks that are coming out that week, and the different categories that those stocks are going to be relative to. So you'll kind of get an idea of, if you had seen Apple on the list, or if you see Amazon or Tesla, you'll say, oh, okay, I didn't even remember that they have earnings coming out this week. Maybe I want to make some changes to, my current portfolio, or maybe I want to make some adjustments to work on some new positions, possibly to add, pre or post earnings, depending. So we're working on devising that, and hopefully we'll have that sooner than later. And, that'll be another thing that's going to, just hopefully help you prepare, for earnings and possibly the trades that are coming about. Again, not only just for an earnings type, not only for these earnings type trades, but also for a trade where, like I said, if you're long Tesla, but you don't want to be long Tesla going into earnings, you'll just have the heads up of, hey, Tesla's got earnings on Tuesday, so be prepared. But I'll let you guys obviously know sooner than later when that's going to be coming out and when that implements, so we can all kind of review over it and go over it. So, anybody think that they would use that or think that would be a benefit to them? I'm going to start putting in a voting thing so you guys can just vote quietly and say yes or no, and then it'll give me an idea if you guys like it or not. So we're working on that. So that email will be good. Has anybody used these pre-alerts and added these trades in that are EOD? Has anybody added these into a virtual portfolio and been tracking them? I have. I know Josh has been tracking some with the studies, and some other people have as well. But anybody been tracking these in the virtual portfolio?
I've tracked a few, Shawn, not as an entire group though, so it wouldn't be good to try to get a trend off of the few that for the ones that I've chosen, if you will.
Okay.
But I tend to use your alerts as candidate lists for a specific idea, like
Sure.
what I have for this trading cycle. For example, I guess I'll say it now as I'm typing a message to you, but I'll just say what I was going to say anyway. To Lee's point, you know, I think that it's important to kind of recognize whether a stock is value or growth. And I think each earning cycle tends to have a little bit, at least a little bit of personification as to how it gets treated. For example, we just saw how high growth got punished with great earnings, and you know, some of the high growth names that exceeded expectations by a lot, but their stocks went down. So that just tells me high growth, if you have a stock in the high growth kind of category, when it presented earnings, you could almost count on it going down for, you know, in sympathy, if you will. So identifying which kind of stocks from your list of candidates for the candidates are great, or the lists are great candidates for strategies, as long as the strategy is consistent with the, you know, what's happening within that segment for this particular earnings cycle. I don't know if that makes any sense to people, but it makes sense to me. So I tend to like try to group the candidates into a category and then trade them on a few of them on a specific trade idea to see how that idea works out. So
yeah, I mean, that's fair.
So like, for example, I've been trying to keep some of my or most of the calendars and diagonals that I've used in what I think are good cases for this cycle and evaluate them, but they're kind of like, they're not enough to make a trend. They're, you know, there are a few that here's how they turned out, but that wouldn't matter to anybody in particular, I don't think. So that's why I didn't speak up at that time. Anyway, that's
gotcha. No, that's fair, and that's what I want to make sure too, is just that you're using, you know, either this quick link virtual portfolio tab or some other functionality to track them, and I think that's great, you know, and we build it, you know, and we do, you know, Shook and the team builds it, and then we do spend a lot of time talking about it. So, you know, I don't want to talk about something if everybody doesn't really use it as often. You know, I find it to be a great tool to help me try to, you know, see what I would do in a certain setup, or see maybe how a trade design would have worked in the past. It's not going to tell me how it's going to do, obviously, in the future, but it kind of gives me the parameters of be prepared for you to maybe take this type of loss, or be prepared to maybe take this type of gain. So then when the trade does come live, you kind of have a somewhat of an expectation of where it might go, so you're not taken aback if something does go out of the ordinary of you know, what the normal person wouldn't expect to happen. You kind of already have seen it and possibly have planned for it. So, you know, that's kind of what I want to make sure. But, you know, I think using your custom ideas, I mean, that's what we're really doing too, right? With the Delphian studies or with the earnings trades is, you know, we design them as good trades or what we think are good trades for you to trade live, but then, you know, hopefully they can be used as, you know, thought or strategy like generators for yourself as well. So if it can generate some other trade ideas from you, then that's great, because, you know, you're coming up with an idea that we had and hopefully making it better, and then using it in your portfolio. So I think that's great. And yeah, you know, you can always go in there and use the stock list. So hopefully when the email comes out on the weekly basis with the stocks that have earnings coming out, you can copy those stocks for that week's worth of earnings, or go into the stock list, you know, based on the Excel file that Josh has shared regarding the trade that we've already, you know, done, the back test that we've done, add them to a stock list within your platform, and then come in here and use the custom screeners to screen out different things depending on, you know, the type of particular stock that it might be, right? So you can come in here and use these different indicators to say, well, I only want to look at certain sectors. I think I was looking to see if we had something that would specify growth or value. We do have that, right, Josh? I think somewhere. I thought we did, but I could be wrong. I'm trying to look as well. So
No,
let's see.
I don't think so, Shawn.
No, we don't. But you could do it by the Delphian grade, which is a great one to use I don't know if that's going to help you segment the different sectors out like value or growth, but I'll look at that a little further. But barring, that particular screener, any of these other screeners, I think, obviously, would hopefully help you depending on the type of screening that you want to do. So you could take that list and possibly add some of these screeners in there and see if you could, optimize that list a little bit better. So I apologize for that if we don't have those one bits in there, but you could probably find some and figure that out another way as well if you had to. Another thing that we're kind of working on, just to give you a heads up, is we have a couple different ways that you can do, certain analysis on your options. When you come into the options and you go into the analysis page, or is it the analysis page? One second, that's actually the options screener page. So in the option screener, so the option screener page that you can use, you can say you want to do a certain type of strategy either on a certain list of stocks, or you can scan, one of our lists that we have already out there, and you can look at these different strategies based on some of the screener criteria. And I know we went over this before, but we're looking to add a covered call section in here as well. So once we get some of those parameters set up, you'll be able to come in. The anticipation is that you'll come in and you will be able to scan, a list of stocks if you have a list of stocks, and see which of those might have the best or the most optimal value based on a percentage return to possibly perform a covered call on. We're not going to be able to right now to be able to take, if you have a handful of stocks that you've already owned for a while and you want to see which options you could use covered calls to pull in a certain return based on your cost basis for that stock. We're not going to have that capability yet, but we're looking to possibly have that down the road. But this covered call feature is going to be another feature within this option screener that we're going to be looking out for soon as well.
Shawn,
so really,
this is Winslow.
yes.
I'd
Winslow.
love to have that feature. That's great.
Good.
For
Yeah,
the
I
covered
appreciate
call.
it. Yeah, and it's just one of those things, that we don't, we think about and then we kind of don't think about, and then we get so stuck on some of these other ones that it's so obvious to have it, but we just didn't have it in this section. So we're pretty much building the screener similar to this here. It's going to be a little bit of the different headers just based on the covered call selection, right? Not a minimum delta, but possibly a percentage return. Yeah, we're going to have that in there, so it'll be cool. I think it'll give you some good ideas of different ways you could add some long positions and possibly a covered call to hopefully collect some premium coming into your account.
And then there's issues about the dividend and what happens to the dividend. You might get called away prematurely.
Right. Yeah, that's a little more deep than, I know a little bit about that, and you got to be careful for sure. So that might be a discussion that if some people want to open up and discuss amongst each other, that would be great. Because you're right, if you're short the call, essentially you're short the stock, right? So the dividend has to come from somewhere, and since you're short the position, how does that work? Does it come from you? Is that typically what they pull the dividend from you, right? If you're short the call?
Right.
Is that correct? Yeah.
Yeah, no, you get called out of the whole thing, right, early.
Oh, they
early.
take the whole position?
Yeah. If you've got a good profit in the stock.
Right. Right. And if the call is obviously, worth them to exercise and do that, it just pulls it away from you. I gotcha.
Anyway, okay, that'd be good.
Yeah, cool. Yeah. So they're working on that. They're almost ready for that. So then what happens is, like everything, they kind of put it into Josh's, mine, and a couple other people's accounts, and then we go in there and just verify and validate the data, make sure it's pulling in the right options like we want it to do, and then kind of run it in that direction. And it'll be similar to this. You'll be able to display only one, which in theory is going to be the best covered call for that particular stock, or you could say show me 5, and then it's going to give you 5 different variables for that same Apple stock those calls that might match that criteria. So yeah, it'll be cool. So kind of be on the lookout, but we'll let you guys know when that comes about. So the other thing that I wanted to show you is there's been a pretty mixed bag of trades, with the earnings trades, and like Dave kind of suggested, Microsoft was a trade that was a non-mover or a vol crush. A bunch of them where the earnings were somewhat positive or even flat, and then the stock still dropped pretty hard. And obviously the Nasdaq has taken a decent drop over the past couple of days, so that's going to affect a lot of those different companies as well. But one that sticks out from last week, and I don't mean to kind of cherry pick it, or maybe I do mean to cherry pick it, is Amazon. You know, so Amazon had earnings come out last week on I think the night of the 29th, which was Thursday. So there's a couple, you know, the vol crush trade is a trade that we've spoke about quite extensively. So I'm assuming everybody pretty much, you know, has a decent idea on how that trade works, that four-legged trade. You know, you're selling the at-the-money, you know, you're selling the at-the-money options, and then you're buying options for protection on both sides of put and a call for the expected move. So that's pretty standard. We kind of get the idea of how that trade works and how that trade works over time. But what Josh was mentioning earlier is we were looking at another trade, and Dave kind of talked about this before, and it's like your diagonal trade. So this one's actually a double diagonal trade. Now, we don't have the capabilities to put the double diagonal trade into the virtual portfolio, into Delphian as a whole trade. So in theory, I'll show you, well, not in theory, but I'll actually show you what the trade looks like, and then you'll know what I'm talking about. So I'm just going to pull up one of these volatility crush, one of these virtual portfolios. I'm going to go in like I'm adding a position. So I went back in time to 429 just to kind of show you what would look like for that Amazon trade. So for Amazon, what we're talking about is we're talking about our normal volatility crush trade, but instead I'm going to look at a double diagonal trade. So within the platform, we are talking about a long call diagonal, which is going to have a diagonal based on calls. And then it's actually going to be, and then we're going to be able to do a long put diagonal as well. I think, and Josh, correct me if I'm wrong, but I think it's going to be more of a calendar spread, right? Because we're using two separate expiration days. The diagonal, you'll be talking about different strikes, right? I mean, and Dave or somebody can speak up too. Let me look at this
that's
real
correct.
quick.
Yeah, correct.
Because I used it, I did the diagonal earlier and it worked, but I had to just manipulate the strikes a little bit. So this is a long call calendar spread. So what I'm doing with a long call calendar spread is, as we know with Amazon and with the volatility crush for earnings, we're looking to take advantage of volatility premium coming into the options for that week's expiration, and then that volatility premium coming out of the options after the earnings announcement. And that typically is going to be seen more so in the options for that week's expiration. But when you're selling those options for that week expiration, you're going to be taking a decent amount of risk, because as in this Amazon trade, if earnings are coming out Thursday night, really you only have one more day until expiration, and then that's it. So you just hope that the stock doesn't really move that much, and then you can collect that premium. So what we need to do to help kind of mitigate some of that risk is use another way to protect us if the stock does move up or down in a big way. We did it with the volatility crush with the iron butterfly because we bought the call for protection further out. So that gives us that protection. But in this instance, on these long call calendars, you're selling that week's option expiration, and then you're buying the following week's option expiration to protect you. Now, when you do that, you obviously are going to pay money. You're going to pay a debit for the spread because you're buying an option that has more time on it than the option that you sold. So typically you're going to be paying a debit for this type of trade. Does everybody follow my explanation with that? Or does anybody not follow the explanation? Oh, okay. I'll take that as a yes. So I'll show you the design real quick. So as of that day when Amazon would come out, the trade design setup was around 34.80. The stock closed a little bit lower, 34.70, but 34.80 is the actual strike that I used when I followed it in another account. So for my for my sell option, again, I'm going to be selling the options that expire for that week, because that's where my volatility crush is going to come from. And then I'm going to look at a 34.80. And then I'm actually going to be buying the next week's expiration, which would be 5.7. And I'm going to do the same strike at the money, 34.80. And so when I do that, we can see that basically my net debit, so we can see it's a debit because I'm buying a 34.80 call, May 7th expiration for $82, selling the 34.80 for this week, 4/30 expiration, $65 and change. Go ahead. Oh, I don't know if somebody's gonna say something. So we can see 1688 is gonna be my debit. So $1,688 would be my debit based on the mid price for that particular trade. So that's one half of the trade. The other half is doing the opposite side of the trade. So you're actually gonna be doing the put side. So just keep this, so I'll create this position real quick. So let me hit create. I'm gonna do this just to put something in here so we can look at it. Just give me 1 second. I'm gonna hit create. I'm gonna come back and I'm gonna add new, and I'm actually gonna add the opposite side of the trade and show you both sides so you can kind of see it together, because essentially you would want to have the trades put on as a whole or as one trade. Makes it a little bit easier to manage it that way in my mind. So again, the sell option is going to be this week's expiration, because that's when the earnings announcement is going to happen. 34.80. We'll be buying the following week's option for protection, same strike, 34.80. And now we can see with this one, it's a debit of 17.58 using the mid price. So last spread was 16.88. This spread is 17.80 or 17.58. So altogether, the trade as a whole is going to cost around 34.73. So almost $3,500. Does everybody follow me so far? Let me put this in here, create. Now this is what the trades would look like. You know, in theory, this is what it would look like if you had it in your account as one trade. You would basically be selling the April 30th 34.80 call and put at the money call and put, and then you would be buying the May 7 34.80 call and 34.80 put, and that would cost you a complete debit of about 34.45 is what it shows here, but about $3,500. So does everybody kind of understand what we're looking at there? Anybody not understand or any questions?
This is Jean.
Yes, Jean.
What did you call this trade, this strategy? Is this the double diagonal? What is this?
Yeah. So it's the double So I was going to show you what it looks like, because I know a lot of people use toss as well. So I was going to kind of show you what it looks like in toss too, so you can kind of see it that way, which it puts it as a whole position. So in toss, this is what it would look like here. So in the green, since it is a debit, this is what the trade looks like right here in your Thinkorswim platform as a double diagonal.
Yeah.
Have you used that before, Jean?
No, I haven't. I've done the diagonal, but not a double diagonal. I didn't. I guess I'm still a little confused. So on the same strikes, you're getting a credit and you're paying a debit?
No, exclude the red one, because the red is actually the normal iron butterfly like we do.
Oh, okay. All right.
Sorry about that. Or the iron condor, but the green is the trade that I was speaking about now.
Oh, okay.
Because it's a debit. Because, you know, for your iron condor, your iron butterfly, we're getting a credit. So that's why it's showing up in red as a credit. But the double diagonal is the one that I was speaking about, yeah. So, you know, just like with your iron condor or your iron butterfly for the volatility crush, you can see on this one here, we're selling the April 30 options, the 34.80 at the money options. So you can see the implied volatility as this column here is around 66 to 67. And that's really what we're looking to drop. We're looking for that implied volatility of those options to drop, because earnings is coming out. And then if not much happens, you know, we'll see the volatility drop. And that's when, in theory, we should be able to, you know, make more money on this trade, because those options are going to drop in value, and the next week's option should hold their value. So that's where you're going to see a little bit of an increase in that, or even rise a little bit.
All of those strikes, the calls and the puts, are the same in that?
Yes, ma'am.
Okay.
Correct.
All right.
Yes, ma'am. That's correct. So that's how the trade's set up. I'm going to work with the team to get this put into the account so we can have it within the platform. So then I can go in and we can actually test it a little bit further, use it within different functionality within the platform. And, you know, and then we'll be able to look at some different results using different stocks and kind of compare, you know, the different trades, whether it be the iron condor and the double diagonal together.
Okay, thank you.
Does that make sense, Gene?
Well, I'll work
That-
on
that-
it.
Yeah, that's the first time me explaining it kind of out loud. So, I want to make sure I kind of cover any questions you might have because, sometimes I come back and say, oh, I wish I would have said that too. So I just want to make sure it's clear. And if it's not, I can work with you too on it. We can kind of go through some ideas too, because it's fairly new, not a new strategy, but a new way to trade those earnings in the vol crush. It's newer to me. So that goes into my point earlier is I'm putting it into the virtual portfolio like this on trades like that. And I'm just following them and saying, okay, would I make or lose money on the trade? Okay, I lost money. How much did I lose? And it kind of gives me an idea of what to expect when I'm putting those trades on live. I didn't do either one of these trades live in my Thinkorswim or in my Tradier account just because of the amount of risk that was on the trades at the time. But at least with the virtual portfolio, it gives me an idea of, what to expect, how would I react if this happened? So.
Right. Okay. Thank you.
So I put these in as a separate trade, but if I go ahead one day, so earnings announcement was 429. If I go ahead one day to 430, now we can see where the trades are, position value gain or loss. And we can see that the position value gain on both of these was pretty substantial. The one trade cost 1688. The 1688 was the cost here, and the current value is 4100 just the next day. So you can see almost a $2,500 profit. And then the same with the one above, almost, a $2,500 profit. So, again, this cherry picking, this is kind of the perfect scenario because if you do look at, the Amazon itself, I had it noted here. Amazon the next day, the expected move was roughly, 100 and almost $200 or so. And, it was only up $37 at the open the next day. So it was very mediocre in comparison to what the market had anticipated based on the values of the options. And then we can see down below as well. Again, if you're looking in the green, the double diagonal, this is the next day, the trade went from 34 almost up to almost 58 and change. By the end of the day, Amazon, I believe, was flat, maybe even down a little bit by the close. So that's why you see a bit more gain, in this value of the options here, because this is taking the prices as of the close of the market. And Amazon, I thought, was pretty flat, 34.67. So, it was down $13 or so from our strike. So you can see that that stock had a mediocre move based on the earnings. Any questions on that? I know it's a different strategy, so it's a little bit newer. It might be newer to some people. Does that make sense, Dave? I know you've traded some similar type strategies, so does that make sense, or did I miss something?
Yeah, I was just going to ask you what your deltas were.
Okay, yeah. Let's see. You can see.
Yeah,
For the total, it's showing. Let me go back.
That was an at the money. That was an at the money trade, right?
Right, at the money. Yep. Yeah. Because the stock closed. The stock closed roughly at 34.71, but I think like 10 minutes or 20 minutes before the market closed, it was around 34.80. So I use 34.80 as my guide whenever I put the trade on.
Okay. But the way I kind of use them both, and I typed out a kind of a thing in the comments there. If anybody wants to call me up and talk about it, we can. But I tend to use them at the 30 delta. So the one standard deviation move above and below the current price, and then if I get the move, then I close that side and leave the other one open. It tends to work out better for the 30 delta, choice and strikes if you're using the more the value trades like that I think Lee was looking toward identifying, ones that don't move quite as much and aren't quite as susceptible to high vol moves. In this particular case, you're almost doing it's almost like doing a straddle, right? Strangle. Well, anyway.
Yeah, pretty much, right?
Yeah. So
you're right.
Yeah. So I think in this case, if you get the move that the neutral move, like you said, the bulk crush trades work out better if you use that strategy as opposed to this one, to the double diagonal or double calendar.
Right.
But the double calendar and double diagonal are obviously cheaper to put on because you're selling you're selling something, so your price is going to go down. Yeah, so I also put some comments there about managing these trades closer. And I would not, if you're just trying this out, just use this week and next week's expirations. Don't try to go further out on calls or the long puts, because you're buying volatility for those longer ones that are more sensitive to volatility, and you're paying a little bit more if it's right before earnings announcement. So it's an interesting trade, but be careful with it, and try one at a time. Don't try a whole 5 of them at once and see how they all work.
Right. Yeah, and I think it's kind of like the volatility crush trade, in my opinion. Or the iron butterfly or the iron condors, you want to get out of the trade as a whole. So 4 legs, like you said, we know these options, the 430 options are expiring the next day, but once these options either expire or I close the trade out, I'm closing the trade out as an entire trade. I'm not, taking the shot, to leave those further out options open, because if I do, then that could, like you said, lead me susceptible to some volatility drop. And then that would really cause a big problem in the value of those options. So, but yeah, to your point, Dave, too, both of these are the almost 50 delta, because they are right at the money, at the money at the time that I put them on. So when you're saying a 30 delta, are you selling and buying both of these using a 30 delta, the strike? Is that what you were saying?
I would definitely experiment, if you're going to experiment, with the calendars as opposed to the diagonals, because it's just a whole, twice as many, degrees of freedom that you're allowing in there to your trade. So stick with the double calendars as you're trying this. But yeah, I use the delta 30 or the 1 standard deviation move on the doubles, and that's why if I get the move right to one of the short strikes, well, that's the highest. That's where that side of the option is going to have its best value, right? Its max gain. So, and if it's you got to 2 or 3 more days before earnings, don't wait, because it's not going to stay there likely. It'll probably move away from there. So close it if it hits your short strike on that side, and leave the other side open so that you can maybe get the return to to the mean kind of situation going for you.
Sure. Yeah, it's an interesting design. So like I said, we were kind of looking at it, and it seemed to work fairly well. There's some trades where it's losing a little bit of money, but like Dave mentioned, this is obviously one of the bigger trades. Amazon, Tesla, those Google, those are really expensive price stocks. So trading options on those stocks might produce some really great returns. But as you see with this Amazon trade, we're taking on a decent amount of risk too. So, I've been tracking it on these. I've been tracking it on the smaller price symbols as well, just to see, again, this is just the great thing of the virtual portfolio, and just, testing it, checking it out, and seeing it before you actually trade it. Because again, obviously, you can lose money on these trades, but knowing, how much you can lose money, where you're losing money at, which of the options are losing the value, and which of the options are bringing the value of the trades down, having all that information like ready to go when you actually get into a trade live, I think it just gives you more comfortability and helps you kind of sit a little bit at ease when the earnings announcement happens, and when the market opens, you're a little more confident, in what you're doing, and just having that done ahead of time and seeing where things move, helps tremendously. At least it helps me kind of have an idea of what I'm going to do. I might not always stick to my idea. I can change kind of plans pretty quickly when it's obviously myself. But having the plan is great, right? And it just helps you solidify what you're doing. So, I wanted to show this design just to kind of spark some ideas. Hopefully, maybe offline you guys can kind of test some of these out, try to look at this type of trade design, the double diagonal, and see if you can create some trades to look at, you know, to follow, not necessarily trade them live, and see what you're getting and kind of see if you can come up with some good ideas. Because there is a specific time, not a specific time, but there is a decent time frame within these options. So the very next day, these options are expiring. So there is a time in that day when probably the most optimal time to get out of the trade is. I don't know when that is, but I'm trying to figure some of those little nuances out. But, you know, there's going to be a time where that value of that implied volatility is sucked out, and then that's probably the optimal time to close the trade. But that's something else that I'm working on. So I'm trying to figure that out. But does anybody have any other questions on that trade design? I mean, I went through it quick, and, you know, it is a little bit more complicated of a trade design, but it's called a double diagonal. We have it in the platform. You just have to use the two separate, the long put calendar spread and the long call calendar spread, because again, you are spreading your time, you're spreading the calendar. So you're doing the two different expirations, this week's expiration and next week's expiration. That's your spread. And like Dave said, the further time you go out, you know, the more kind of exposure you might have on your trade. So, you know, just kind of track them and see what you got. But any questions, anybody? No questions?
When
Okay.
would you do it? Would you do it during the earnings season? For what reason would
Yeah,
you do
these-
it? Because of more profit or less risk?
Well, these are done just like the volatility crush trades from what I've found so far. They're put on pretty much right before the earnings announcement, and you're getting out the next day. That's how I have been trying to test them and trade them. And you can see within this little snippet that I have, you know, that's kind of what you're looking at. This is the original iron condor like we've been talking about. And, you know, my risk is essentially $20,000 because my spread difference, my 3480 to my 3680, $200, which is $20,000. I'm getting a credit. Let's just round up to 130. I'm getting a credit of 13,000. So my risk, in theory, you know, my total risk is $7,000, right? But for the double diagonal, if I set it up, my risk is actually 3,500 if I round it up. So I got half of the risk in the double diagonal versus than I do in the trade up top. And then you can see the very next day, I mean, the return on risk is a lot better on the double diagonal than it is on the iron condor. And again, this is, you know, kind of looking at Amazon and not looking at any other trade. Other trades are going to be, you know, can be substantially different. But yeah, it's going to be a trade right before earnings, and you put the trade on, and you're really playing the same thing. You're playing the volatility crush on these April 30 options. You're really looking for that volatility to come out of those options.
Okay.
So yeah, any trades coming up that have earnings coming out, you know, set it up and just follow it and track it, and you know, don't trade it until you get a good comfortable, you know, until you're comfortable trading it. But look at it, kind of identify where your risk is and where your potential profit is, and the different areas of the market of where it can move. And I think that'll help you, you know, maybe find another trade design that you can add in depending on, you know, the comfortability of the actual trade.
Okay, you're saying put it in right at like Delta 50, but Dave was saying at Delta 30.
Yeah, Dave adjusts his a little bit. I need to talk to Dave a little bit offline just to figure out how he's constructing them, because I think, and I don't want to speak for Dave, but Dave is constructing them a little bit further out. He might be taking a bias to one side or the other,
Exactly.
and you can do that. Go ahead.
No, I wasn't going to step in. Go finish, and then I'll you know, rebuttal, or not rebuttal, but I'll, you know.
Because you can kind of set these up to where you're biased one direction or the other. So you could do a long call calendar spread by itself, or a long put calendar spread by itself, and take a bias on the market one way or the other. But this is really just saying I don't have a bias, and I'm still just using the volatility crush, and that's it. I haven't figured out how to design it to take that bias into account, and that might be what Dave is going to speak about. But yeah, go ahead, Dave.
Yeah, okay. So yeah, the trade that Shawn outlined was a neutral, or you're planning for, you have a bias for no move. And the trade that I typically use is, it's kind of like an inside out, a iron butterfly, where okay, I'm playing for a move to the market maker move on either side, but I don't know which side yet. So I'm selling volatility in the first in the front week, and I'm playing for the move to, like I say, right to the short strike. If it's a market maker move that's at 30 delta, that's why I choose the 30 delta strike above and below the current price as my strikes for, you know, both the calls and the puts. So, you know, it can't move both ways. So one side's going to not work out as well as the other. That's one thing you got to contend with. But you tend to you have a ability to close out when you're winning and hope the other side then recovers and, you know, kind of win that way, which is kind of what you do when you're managing the iron butterflies as well to some extent. So yeah, if you have a bias, or if you have a bias in the width of the move, that's where you choose your short strikes. If you don't think it's going to move very much, you choose your closer to at the money strike. If you think it's going to move 5%, 10%, or, you know, 30 delta or 10 delta or 20, choose your strikes right at those deltas and, you know, see how it works out. So it's a matter of you're correctly identifying the potential move, the market maker, you know, the difference from where it is today to where it might be when you choose your short strikes. Does that make any sense? So I use it as a directional play. Shawn is using it as a non-directional play. And it's all
Dave, are you still setting it up? Go ahead.
No, go ahead. What was the question?
I was going to say, are you still setting it up this way as like a calendar spread, and you're paying a debit for it? So you're still using, let's just say, this week and next week's expirations.
Correct.
But is your sell leg at the money, or is your sell leg is at your 30 delta? That's not your 30 delta, is it?
My sell leg's at the 30 delta on both sides. For the calls, it's 30 delta above, and for the puts, it's 30 delta below, the way I do it.
Mm-hmm.
And then, you know, one way or the other, the first week is going to get, you know, the IV is going to crush the next week. So both the short options are going to decrease in value from what you sold them as, and the longs then, you know, you can manage once if you use this as an earnings play. Once the earnings are out, then you have a chance to say, well, you know, are they going to how accurate were they compared to where all the analysts were thinking? And you can then make a judgment of, well, is it going to continue? Will the move continue to sustain, or will it like revert to the mean, which kind of has been what has been happening to some of these. Well, it depends upon the underlying you're talking about, so they're all different. So, but
right.
That's my answer to the question. Is like if you have an idea of how much the move might be, choose your strikes that distance away from at the money. If you think it's not going to move at all, do what you just did. Choose the at the money price.
Oh, be the neutral. Right. Gotcha. Okay. I see. Okay, but still the same trade design. Just you have that gap between the strikes for your options that you're selling. So you have the gap in the price where it can move either up or down. And you're
I'm talking only about the double calendar at this time, because like I say, if you get into the diagonal, then you have you know, you have a vertical embedded in a horizontal at the same time. So it's
right.
It's a whole lot more to try to get your hands around or head around if you're with a double diagonal. So I'm just saying, it's you know, start with the double calendars, and it's use or just a calendar. If you have a bias to one side and you think the stock is either going to move up or down, just choose one side to do a calendar at the 30 delta on the put side if you're bearish, or on the call side if you're bullish. Then if you right on direction, you have a real good chance of winning fairly big with a smaller capital risk, because your short option is giving you money, you know, is taking away the cost of the long option. Okay, I mean, if anybody wants to talk about it, I'll talk about it for hours if you want to talk online. Or I enjoy talking about this, so call me if you like.
No, that's cool. Yeah, that's cool. And yeah, any questions? And if you have any questions, anybody, you know, send them send them to me, or like Dave said, you can coordinate with Dave and he'll talk to you. He knows a little bit. He's traded them more actively than I have, so he might be a better asset to use if he doesn't mind talking about it, because I'm still kind of in the testing phase and trying to verify what does happen. If I'm being biased to one side or the other, which way can I construct it the best to possibly make the most potential return, but still be able to view what my risk is going to be if I'm wrong. So I'm still kind of testing, and I wanted to throw it out there because I thought it was an interesting design that we had come across, and it seems fairly fruitful. You can kind of help minimize some of your risk or lower the risk from what we've seen with the iron butterfly trade, and still get some pretty good results if you're right. If the market doesn't move and it is neutral, then it can show some pretty good returns over a short period of time. You're paying a debit versus the iron butterfly, we're getting a credit. So there's definitely the differences between the trade there. And then obviously the difference between the trade works as well. So, I just want to make sure you're comfortable, but wanted to put it out there. I hope if it did spark some interest, you can go offline and do some studying, and maybe next week we can kind of bring it back up and see if anybody's been tracking it or been looking at them and they have any thoughts or ideas, and we can kind of dig a little deeper in them. But, I just wanted to make sure that we're not kind of getting stuck in just hey, here's the iron condor. Let me show you how this trade works. I found this idea. And again, I might not have explained it the best of ways because I'm still trying to speak it out loud and explain it. But, like I said, I just wanted to show you guys, hey, here's another way, another cool trade design that we can look at of trading these earnings trades. And some of them might show some really good results. So, just take a look.
Shawn?
Yes.
It's Jean again. I was just
Yes,
curious
ma'am.
if anyone has been doing any of the straddle trades, because you're buying on the straddle and during earnings. And I was just wondering if anybody had been using those and what their experience was.
Yeah, so like the vol rise or the movers, anything like that.
Yeah,
Has anybody? Yeah, go ahead. Sorry, Gene.
No, that's all right. Nobody.
Has anybody been doing those trades? Have you done some of them, Gene?
No, but I've been thinking about it, but I was curious. I mean, it seems like they would have to be a mover.
Right.
Right. And
yeah,
I don't know, it seems like it would be a little, I mean, are you using them for the earnings only? Or
those typically, my history has been those typically are just used for, the times that I found those to produce the better results would be around a time like earnings, or, if there's some type of an event coming out that could impact that particular stock or that particular sector, because that's kind of where that volatility is probably going to increase. And then who knows what's going to happen when that event comes out. And then earnings is a good example of who knows what's going to happen when earnings comes out. So the stock can move up or down. So those volatility, right?
Yeah, I just haven't seen that particular strategy used, and of course not that much. And so I was just curious if anyone had worked on it.
Yeah, and it's hard, I think, too. Some of these, it's hard on some of in my experience, it's harder on the ones that are expensive because, as I've talked about before, if I can do multiples of them, that's where I want to be. So if I can do, 2 strangles, that's better, because if the stock does maybe rally, then hopefully I can just sell one of my calls to cover, the entire cost of the trade, let's say, in the perfect scenario. And then that still gives me 1 call and then 2 puts to potentially make money on at a later time. But, if the strangle or the straddles cost, $2,000, I'm like, well, I don't know if I want to risk $4,000 on a 2 lot. So then I might have to pass on that trade. And that's me personally. So that's kind of the thinking that I go into them. And some of them, it's hard. It's very difficult to get some of those to be some pretty big movers, in my opinion, especially if you're not holding them through earnings.
Right. And then also another question, I don't know, you may have answered this because I came in a little late. It seems like some of these earnings trades, they had good earnings, but they dropped. I mean, it seems to be the typical thing rather than, I mean, why is that happening? I mean, if they have good earnings, why are they dropping? So,
Because they
Yeah,
were
and-
thought to
and
be
that's-
overvalued.
I'm sorry, what?
Right.
That's because the people that are selling them thought they were over, their valuation was too high. That's why.
So.
And that's what Dave spoke about a little bit earlier. Some of those
Oh.
stocks in that particular sector, you know, like a Microsoft.
Yeah.
Even though Microsoft came out and it had the earnings that beat expectations, and then you see the stock down, 5 or 8%, and you're like, why did that happen? And like Dave said, they might, people are already assuming that Microsoft is overvalued based on where it was previously, so they just push the stock price down. Yeah.
Oh, I'm sorry.
Yeah, you buy the rumor, you sell the news. So we're buying to go along the pre-runners. You get out before earnings. They sell the news for a couple of days and you buy the dip.
Buy the dip, yeah.
Yeah. Yeah, I was just working on the iron flies on a couple of things, and of course they went beyond the expected move, so it didn't turn out to be a good trade, particularly Netflix, that kind of thing.
Yes. Yeah.
And yeah, but anyway.
Yeah, I was on the Netflix one as well. The Netflix and the Microsoft, both very, very difficult trades, and so there's those things definitely, you see them and you're like, man, that it's not typical. And then you have the ones like Amazon and Tesla, and then you're like, well, okay, that's just the nature of the beast, But
I didn't do Tesla. Did you do Tesla?
I did Tesla, and that one worked out well also. That always seems to be a pretty standard to where people want to pump it up and buy it, and then earnings comes out and it just stays kind of just blah, But that was one I spoke to Josh about too, and previously, because the implied volatility on the options was substantially lower than what it typically is. Right. So, typically the implied volatility on those options is above 200% before earnings, and before earnings, they were only around 80%. So it was very surprising how low the implied volatility was, but the trade still worked out. Whereas you would think that maybe that volatility being so low that the options wouldn't lose that much value, but they still did. So.
Yeah. Okay.
But yeah, let's and then Gene too, we can talk about some things, regarding Netflix and Microsoft, you and I, if you have time later this week. There's a couple trades that go ahead.
Too. I'll be in touch.
Okay. Yeah, there's a couple things I noticed on Netflix that not the same trade, the Iron Butterfly, but there was another trade design that I came across that kind of, you can look at it in a market like that. So just to everybody's note, so Netflix obviously had a big sell-off after the earnings announcement, and you can see sometimes stocks after they sell off, they either hold that level for a couple days and then all the options expire, or they hit that level and then maybe they revert back and move higher or continue lower. But there's a pretty low risk type trade that you can kind of add on when you see some stocks maybe make a move like that. Doesn't mean it's going to work, but that's kind of something that I'm testing out as well. So I can talk to you about that, Gene, and then anybody else that might be interested in it. Once I explain it to Gene, feel free, and we can kind of get together and look at it. So.
All right. Thank you.
All right. Well, I ran over my time, guys, so I apologize, but I enjoy it when we all get to talk and kind of spit ideas back and forth. I think it helps me and it helps everybody else too, I hope. So check out this double diagonal, look at it within the virtual portfolio or whatever other system you might use to track some trades, and see if you can come up with some ideas. And, if you have any questions about it, reach out to me and we can get together and kind of work on it and look at it as a whole. But, that's all I had. So I appreciate you guys taking the time, and, we'll be on it until next week.
Thank you.
Yeah, thanks, Shawn.
Thanks, guys.
Very interesting strategy. I think if we can decrease the risk and improve the returns, then that's the goal, right? So we'll see. We can circle back to this next week, but thank you. Well done. So thank you all, and we'll talk to you next week.
Thank you. Bye.
Yeah, thanks, guys.
Idea.
Everybody.
Bye-bye.